Hi, we are Company D, and this is our BSG presentation. My name is Jamie.
I'm William.
I'm James.
So I'm going to be going over our financial performance, starting off with net revenues. For year 10, we earned approximately 400,000, and in year 18, it was about 1.5 million. That is a 250% increase over a fairly linear growth, and our largest growth was from year 17 through 18 with a 26% increase. Our earnings per share for year 10 were $2, and in year 18, they were $17.68. That's a 784% increase overall, with our largest increase being $7 from year 17 through 18, and that's a 67% growth. Moving on to our return on equity. In year 10, it was 20%. In year 18, it was 29.2%. I'm sorry, it was 30%. We experienced some dips in year 13 and 17, and that can be traced back to the purchase of space and equipment. For our stock price in year 10, it was $30, and in year 18, it was $407. That's a 1,200% increase. And our largest increase was from year 17 through 18 with an 82% increase. For our credit rating, in year 10, we received a B, and in year 18, we received an A+. It peaked in year 16 and then remained the same throughout year 18. Our image rating in year 10 was 70, and in year 18, it was 87, and we peaked in year 16.
So I'm going to discuss our strategic vision. And our strategic vision or mission statement is to produce an affordable and reliable shoe with the goals of establishing recognition internationally while continuing to edge out competition with a high quality and low cost product. We believe that through this mission statement or strategic vision, we can attract the biggest consumer market as well as leading our industry in profitability as well. As for our performance targets, we got these predictions based off of our year 18 numbers at first. So with our earnings per share, we hope to increase it 25% annually. We believe with that slight increase, it will continue to help us prosper over our competitors. With our return on equity, in 2018, it was 29.2. And once again, with this, we're not looking for an annual increase, but we're looking to maintain above at least a 25% return on equity. With our credit rating, we've been repeatedly been having an A or A+ ranking within our credit rating. And we hope to maintain this in the year 19 and year 20 if we were to continue. And by doing so, we will just borrow new loans and continue to pay off our current debts. For our image rating, our target is to hit 90. In year 18, it was 87. And in order to increase in the next 2 years, our image rating, we hope to just focus on increasing market shares in the branded and private label footwear, as well as continue to display corporate citizenship and conduct operations with our social responsibility as well. And for the stock price target, we also use that 25% marker as an annual increase. While from year 17 to year 18, we saw about 100% increase in our stock price. We don't believe that we can continue to turn over that significant of an increase. So a 25% increase annually will be beneficial for our company.
So I'm going to talk about our competitive strategy across each market. So for internet market, we basically, like it said in our mission, we wanted to be the low cost leader. And we also put a really big emphasis on market share because we saw the more market share we had, the more money we would make. So basically, we wanted to maintain the lowest prices while also achieving the highest market share. Each year, we undercut prices based on the industry average from the years prior. And we increased prices slightly from year to year, generally somewhere between 25 and 50 cents. There were some exceptions to that, but we never went over or we never increased more than $1. We also wanted to maintain an SQ rating of at least a 5.0. So between the SQ rating, what we spent on advertising, and this allowed us to achieve the high market share that we wanted. As for wholesale, it was generally the same as internet market. Again, low prices, but we actually changed prices even less than we did in internet market. So generally across the board in um, each market, so North America, Asia, etc. From years 11 to 14, we saw no change, and years 15 to 18, we saw no change. Obviously, there were exceptions to this, but generally that was the trend. And we adjusted as needed. Again, emphasis on market share. And then also we would offer free shipping, mail-in rebates when feasible or profitable. And also, just back to the prices really quick. In year 16, we actually did raise prices by $4.75 only in the Asia Pacific segment. And this actually proved to be really profitable, and we were able to achieve 33% market share, which was the highest that we achieved over the 18 years. So private label, again, we just wanted to keep the same thing, low prices, little to no fluctuation. But a big thing was in years 11 and 12, we actually didn't sell any private label shoes. And then we started to kind of see that there were some other companies that also did the same thing. So we jumped in year 13, which was able to get us a really good market share. We actually would end up maintaining at least 25% market share in every segment for the 18 years following. And again, 5.0 SQ rating was really important. That was what ultimately gave us that 25% market share.
So as far as our production strategy goes, there's a lot of data on this slide, but just to give a summary of it, the three factors we focus on are the plant capacity and location, the use of overtime, and the workforce compensation. So to start with the first factor, our strategy within plant capacity and location, as you can see, our total space availability by year 18 was 27 million pairs. And our plan with that is to just continually to construct additional space as our operations grow and as our business continues to be profitable. With the use of overtime, our total overtime this past fiscal year was 34 million. And now both overtime and our workforce compensation are very similar, as our plan going forward with them is that we do expect increases in them, but in order to maintain our strategic vision of being a low-cost provider, we want to be able to mitigate these expenses with the smallest margin possible in order to just keep producing a low-cost product.
As for the finance strategy, so for credits and loans, we took out a couple loans pretty early on, basically just to fund expansion. So we were able to purchase space and brand new equipment, and we also opened facilities right away in Latin America and Europe. That was just so that we could sell as many shoes as possible. We also tried to pay these loans off as quickly as possible to keep our credit rating high. We issued 1,000 shares of stock in year 13. That was because we were a little bit strapped for cash and we didn't want to take out another big loan. So that was issuing those shares gave us the opportunity to get some more cash in for the end of the year 13. And then dividends, we didn't issue any dividends from year 11 to 15, just because we felt we shouldn't be paying out when we had those loans to pay off. But year 16 and 17, we gave out $2 million worth of dividends, and then another $4 million in year 18, just to exceed investor expectations and give back a little bit to the investors. And then as for stock repurchase, we repurchased 300 shares each in year 17 and 18. This was a little bit of an attempt to drive up the stock price, but it didn't really work as well as we had hoped. but the dividends definitely help with that.
And now I'm going to discuss our strongest competitors within the internet, wholesale, and private label market. So to begin with the internet market, Company A was our biggest competitor. And as you can see, the numbers speak for themselves, as we did continue to edge out Company A as well as the industry average in all financial markers. In terms of greater pairs sold, we had a greater market share, and our SEA spending was 9 million. SEA stands for search engine advertising. So our company valued putting money into advertising in order to increase our profitability in that. And then with our wholesale market competitor was also Company A is our biggest competitor. And what's interesting about this data is that our wholesale price per pair of shoes was lower than not only Company A, but also the industry average, displaying our strategic plan and vision even more to be a low-cost provider. And just from this data, you can see that while we were able to maintain that low price, we also had the greatest market share and the greatest amount of pairs sold, while only having half the amount of retailer outlets, with only 2,500 as Company A had 4,800. And then with private label, our company had no production in the North America facility. However, from our data, our Europe, Africa, and Asia Pacific facilities were very similar with private label. Once again, Company A was our biggest competitor in this sector as well. And we had very similar numbers with Company A. Our offered price was a little bit lower. However, our pairs offered, our pairs sold, and our market share was exactly the same as Company A's. And our strategy to outcompete Company A would be to, in the internet sector, would be to just remain being a low-cost provider in every facility and in every country that we're operating in. And with our wholesale sector, we do believe that maintaining our lowest prices will be able to be our biggest competitive advantage, as well as increasing our factory capabilities when needed and increasing our market share in those sectors. And then with private label, we hope maybe in the future we will start to do private label within the North America facility. However, at the moment is not benefiting us greatly. So we will continue to just keep our 25% market share in the other two facilities that we're currently operating in.
Okay, and closing off with our lessons learned. So in order to craft a winning strategy, failure is necessary as well as trial and error in order to find out what decisions optimize success. And it's important to always have awareness of the market and changes with competitors and strategies. So in order to not be successful, somebody should do little to no planning and ignore competitors and their decisions. So that closes our presentation. Thank you.